The Big Six banks just released their 2024 Q2 earnings. We are going to take a look at both the winners and the losers as we get an overall feel for the Canadian banking sector. Hold on to your seatbelts, folks. This is going to be a good one. Canada's Big Six banks are the largest by market cap, and they make up the core of our financial system. In addition to Canada, they do also have a significant presence internationally. A continuing story in this quarter has been the preparation for the wave of mortgage renewals that are going to hit the sector sooner than later. Homeowners previously enjoying pandemic low rates are about to get a change up that many of them they can't really afford. Most of the banks did increase their loan loss provisions, and that did impact some of their earnings. If they were not putting aside cash for defaults, things would get very, very bad pretty darn fast when those renewals roll in. The Bank of Canada has rate cuts coming, and as we're filming this video, they did the first cut yesterday of 25 basis points, so that's already on the table. Nonetheless, these cuts are not really going to make a huge difference initially. For folks who can just make the current payments on their current low rates, they're still going to struggle on the renewed rates, even with that 25 basis point cut, or perhaps maybe 50 later in the year. Unfortunately, there are going to be people who lose homes, and the banks, they're going to feel some of those losses, which is why it is a good thing that they have a lot of money set aside to help absorb the blow. Another story in these quarterly reports was the restraint on hiking dividends. In fact, only 2 of the 6 had a dividend increase. BMO raised their quarterly dividend from $1.51 to $1.55. The other one was RBC, which saw a 4-cent bump from $1.38 to $1.42. A lot of folks thought, maybe even expected, that Scotia Bank was going to raise theirs, but they did end up holding off this time around. Join the conversation. Let us know in the comments if you hold any of the Big Six. Thank you once again for your participation. If you love this sort of content, be sure to subscribe for more, and another huge thank you for that click. In just a moment, we will look at the main highlights of those 2024 Q2 earnings. Overall, I do think most of the banks performed well in the sector, especially when you do take into consideration that many were adding to their loan loss provisions. I do believe that as rate cuts continue, it will benefit the sector, and I am expecting better quarters ahead. So without any further ado, let's do this. We will start with Scotia Bank, ticker BNS. Their earnings were expected to come in at $1.56 per share. They did beat that just by a wee bit, at coming in at $1.58 per share. The revenue, they were expected to clock in $8.30 billion. Well, they did beat that as well. They clocked in $8.35 billion. So overall, they absolutely get a pass. Scotiabank is one of the companies that did not raise their dividend, so it's still sitting at $1.06 per share. That is a 6.567% yield. Their earnings growth is expected to grow over the next 5 years by 6.42% per year. If we look at their fair value using a discounted cash flow model, we do get a fair value of $116.51. That does paint them as being undervalued by 44.7%. Putting that into perspective, their current price is $64.06, well, at the time of recording, and that 1-year forecast, that's coming in at $68.15. So we're looking for them to potentially grow by 6.60% over the next year. Scotiabank squirreled away more cash in this quarter for loan loss provisioning. In fact, they bumped their fund up to almost $1 billion. When we look forward into Q3, they likely will maintain elevated loss provisions, and they could even add more if the economic indicators move in the wrong direction. Next, we will look at Royal Bank. Their earnings were expected to come in at $2.75 per share. They beat that by a good amount. They came in at $2.92. Their revenue was expected to come in at $13.49 billion, and they beat that pretty good too, coming in at $14.15 billion. They get a huge pass. They are one of the top performers this time around. Royal Bank is one of the ones that did increase their dividends once again by 4 cents. So that does put their dividend at $1.42 per share, and that of course is a 3.75% 2.56% yield. Their earnings are expected to grow by 2.85% per year over the next 5 years. Looking at their fair value, that comes in at $211.97. So that does paint them as being undervalued by 30.1%. Their current value is sitting at $147.81, and that 1-year forecast is to have them move up to $153.57. That's a 3.96% growth rate. Royal Bank had significantly increased their loan loss provisions in Q1, but for the most part, they mostly held it steady in Q2. Now, looking ahead to Q3, there is cautious optimism as inflation rates stabilize. Potentially, that could ease interest rates, and that could benefit the Royal Bank's future provisioning. Up next, we have TD Bank. They were expected to come in at $1.85 per share. Their earnings actually came in at $2.04 per share. Their revenue was expected to come in at $13.53 billion. They recorded $13.82 billion, so they do get an overall pass. There was no change in their dividend, so that dividend is still $1.02 per share, or a 5.361% yield. Their earnings growth is expected to grow by 7.78% per year. Now, their fair value using a discounted cash flow model, that comes in at $138.95. So that does paint them as being 45.7% undervalued. Their current price, pretty low for TD, $75.19. That 1-year forecast is $85.76. So we're looking at about a 14.04% rebound over the next year. The story of TD lately has been, well, the money laundering scandal. And as new information comes to light, this could be a theme of Q3 as well. Up next, we have CIBC. Their earnings were expected to come in at $1.66 per share. They did beat that. They came in at $1.75. On the revenue side, they were expected to come in at $0.06 billion. They actually came in at $6.10 billion, so they do get an overall pass. With their dividend, there was no change. It's still sitting at 90 cents per share, which actually works out to 5.323% yield. Their projected earnings growth is looking to come in at 2.79% per year over their next 5 years. Their fair value, that comes in at $120.53. That paints them as undervalued by 43.5%. Their current value, that comes in at $67.52. The 1-year forecast for these guys, that's coming in at $72.38. So they are expected to grow this year by 7.44%. Even though CIBC did outperform expectations, they were a little less impressive than their Q1 results. They did not make any significant changes to their loan loss provisioning, but we'll definitely monitor the economy in Q3 to see if they need to make any further changes. Moving on to the Bank of Montreal, they were expected to come in with earnings of $2.77 per share, and they came in at $2.59 per share. So they didn't do so well. On to the revenue, they were expected to come in with $8.05 billion, and well, they came in at $7.97 billion. So they do get an overall fail. They are the only big bank to miss expectations this time around. It's starting to become a little bit of a trend. Let's hope they can reverse that. Now, despite their poor performance, they did boost their dividend by 4 cents, taking it up to $1.55 per share, which is a yield of 5.177%. Their earnings growth, that comes in at 11.40% per year over the next 5 years. They have a fair value of $196.67. That does make them undervalued by 38.3%. Their current price comes in at $121.28. The 1-year forecast is looking at $129.64. So that's an improvement of 8.52%. BMO missed expectations once again, and they did not make any significant changes to their loan loss provisioning strategy. They are likely to continue a rather prudent approach into Q3, with provisions expected to remain high amid ongoing economic challenges and, of course, market volatility. And finally, we have National Bank. They were expected to have half earnings of $2.45 per share, and they did beat that. They came in at $2.54. On the revenue side, they were expected to pull in $2.79 billion. They beat that as well, coming in at $2.84 billion, so they also get an overall pass. There were no changes to their dividend, so it's still sitting at $1.06 per share, a yield of 3.723%. Using a discounted cash flow model, their fair value, it comes in at $191.78. That paints them as being undervalued by 38.9%. Their current price sitting at $117.68. That 1 year forecast, $119.92. So that's only a 1.94% growth. But the way they've been growing in the past, I have a feeling they could exceed that. National Bank once again has a good solid quarter. The focus on Q3 is of course caution, as we've seen with most of the other banks. They recognize that there could be a potential for higher loan loss provisions, and they will monitor the economy closely as a result and make changes as needed. So let's check out their total returns for this year to date. Holy banana bread, look at this. National Bank coming in at number 1 with 19.50%. Royal Bank, not too shabby either, 12.90% total return. CIBC coming in at 9.27%. Scotia Bank, 4.75%. And we get our bottom two. BMO, they're in the negative 5.49%, and TD bringing up the caboose at negative 9.39%. Of course, once the money laundering does leave the news cycle, we're probably going to see TD rebound quite a bit. We will be back here after the next quarter, and we'll do this all over again. I can't wait as we hopefully start to see a wee bit of positive growth, spurred on by this rate cut, and who knows, we may have another before the quarter is done. As usual, if you are interested in any of these bank stocks today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on TD. Thank you for watching, and I will see you in the next video.